Okay, so picture this. You go to apply for an apartment or maybe a car loan, and the landlord or lender says they're going to check your credit score. And your first thought is either great, no problem, or oh no. But here's what's wild. Most people in that moment have no idea how that number was built. They just sort of hope it's okay. And that's the mistake. Not the not knowing, that's totally understandable. The mistake is thinking your credit score is some mysterious grade that happens to you, instead of a scoreboard you're actively playing every single day. So today, let's pull back the curtain. By the end of this video, you're going to understand exactly how that three-digit number is built, what actually moves it up or down, and why some of the most common things people do, thinking it'll help, actually backfire. Let's get into it. Here's what most people assume. They think a credit score is basically a measure of how much money you make or how responsible you seem as a person, like it's some holistic vibe check. And they also assume it's one score, one number that just lives out there somewhere and gets updated occasionally. Both of those assumptions are wrong, and they matter a lot. First, your income, not in the score. Your job title, not in the score. Your savings account balance, still not in the score. Your credit score is purely, and I mean purely, about how you've handled borrowed money. That's it. Second, you actually have multiple credit scores, not one. There are two main scoring systems, FICO and VantageScore, and they each have different versions. FICO alone has dozens of models, and three separate companies, Equifax, Experian, and TransUnion, each keep their own file on you, which means the same scoring formula can spit out slightly different numbers depending on which bureau's data it's reading. So when someone says my credit score is 710, what they really mean is one version of one of my many credit scores is 710. Now, here's the number that does matter. All the common scores run on the same basic scale, 300 to 850. 300 is basically rock bottom. 850 is a perfect score. Think of it like a trust meter. The higher the number, the more lenders trust you to pay them back. And that trust, or lack of it, has real dollar consequences we'll get into. All right, so how does the number actually get built? Let's walk through it. The most widely used score is the FICO score. FICO stands for Fair Isaac Corporation. They invented the scoring system. Your FICO score is calculated entirely from the information inside your credit report, which is basically a detailed log of your borrowing history. 5 factors go into it, and they each carry a different weight. Here they are, from most important to least. Factor 1, payment history, and this is the big one. It makes up 35% of your score. That means more than a third of your entire credit score is just one question. Do you pay your bills on time? Late payments? Missed payments? Accounts sent to collections? All of that lives here and drags the number down. Even one missed payment can hurt you. This is the lever that matters most. Factor 2, amounts owed, also called credit utilization, 30% of your score. This isn't just about how much you owe in total. It's specifically about how much of your available credit limit you're using. Think of it like a gas tank. If your credit card has a $10,000 limit and you have a $2,000 balance on it, your utilization is 20%. That's fine. But if your balance is $8,000 on a $10,000 limit, that's 80% utilization. And lenders see that as a sign you might be stretched thin. The general guideline you'll hear is to keep utilization below 30% and ideally below 10% if you want the best possible score. Factor 3, length of credit, history, 15% of your score. The scoring models look at how old your oldest account is, how old your newest account is, and the average age of everything in between. Longer history generally helps. This is why people say don't close your oldest credit card, even if you barely use it. Closing it can shrink your average account age and ding your score. Factor 4, new credit, 10% of your score. Every time you apply for a new credit card or loan, The lender runs what's called a hard inquiry on your credit file. That temporarily nudges your score down by a few points. It's not huge, but opening several new accounts in a short window looks risky to the scoring models. This is very different from checking your own credit score, by the way. Checking your own score is a soft inquiry. It doesn't affect your score at all. Check it as often as you want. Factor 5, credit mix, 10% of your score. This is about variety. Having a mix of revolving credit, like credit cards, and installment loans, like a car loan or student loan, shows you can handle different types of borrowing. It's the smallest factor, and you don't need one of every type, but it does count. Now, here's something really important to understand. Your score isn't calculated once and stored somewhere. It's recalculated fresh every single time a lender or service requests it. So as your credit report data changes, a balance goes up, a payment posts, a new account opens, your score can shift. It can move multiple times in a single month. And one more thing that trips people up. Negative information doesn't stick around forever. A late payment typically stays on your report for 7 years, but its impact fades over time as newer positive behavior piles up. Let's make this real with an example. Meet Aisha. She's 29, works as a graphic designer, and just got her first credit card 2 years ago with a $5,000 limit. She's been paying the minimum balance every month, on time, no missed payments, but she's been carrying a balance of around $3,800 on that card. She checks her score one day and sees it sitting at 620. She's confused. She pays on time. Why isn't her score higher? Let's diagnose it. Payment history, she's good here. No late payments, so this piece is working in her favor. Credit utilization, here's the problem. She has $3,800 on a $5,000 limit. That's 76% utilization. Remember, the models treat anything above 30% as a yellow flag. At 76%, this is hammering her score. It's the single biggest drag on her number. Length of credit history. She only has 2 years of history and just one account. This is short, and it's pulling her average age down too. New credit. She hasn't applied for anything new recently, so no problem here. Credit mix. She only has the one credit card. No installment loans. That 10% category isn't really working for her. So the picture is, she's doing the most important thing right, paying on time, but her utilization is wrecking 30% of her score, and her thin, short history is limiting the other pieces. Now watch what happens when Aisha gets a bonus at work and uses $2,500 of it to pay down that card. Her balance goes from $3,800 down to $1,300. That's a utilization rate of 26%, now below that 30% threshold. The next time her card issuer reports her updated balance to the bureaus, which typically happens once a month, her utilization number improves. Within 1 to 2 billing cycles, her score could jump meaningfully. Paying down high card balances is one of the fastest ways to see score movement. Building a longer history, though? That just takes time. There's no shortcut there, but here's the encouragement in Aisha's story. She went from feeling like her score was broken to understanding exactly which 2 dials to turn. That's the whole game. So here's what you now understand that you probably didn't before. 1. Your credit score is not about your income, your savings, or your personality. It's calculated purely from 5 specific things in your credit report. And payment history and credit utilization together make up 65% of the whole thing. Those are the 2 dials that matter most. 2. You don't have one credit score, you have many, calculated by different models from different bureaus. The number you see in an app may not be the exact same number a lender pulls. That's normal. What matters is the general health of your credit data, because all those scores are fed by the same underlying report. 3. Some things people assume help actually hurt, or at least don't help the way they think. Carrying a balance on your card doesn't build credit. Closing an old card can actually lower your score. And checking your own credit, totally harmless. Soft inquiry, no impact, check it whenever you want. And that's really the foundation. Once you understand how the score is built, all the advice out there starts making sense because you can see why it works. If you want to go deeper, the next place to look is your actual credit report, not just your score. You're entitled to free reports from all three bureaus at annualcreditreport.com. Pull them, check for anything that looks wrong, and get familiar with what's actually in your file. That's where the real information lives. If this video was helpful, hit subscribe. We break down money concepts like this every week, always in plain English, never with jargon. And drop a comment below. What's one thing about credit scores that surprised you? I read everyone. See you in the next one.